The lead, you guys reminded me. Yeah, for sure.
What a big one.
It's hard to what?
Hear you?
You're kidding.
On my computer.
Oh, on the computer. I think you meant in person. You're kidding me. Yeah, sometimes the volume records really loud, sometimes not, and I don't know why. Because I check the settings every day, and it's bizarre. It does the same thing on mine. It does tend to be quieter anyway, doesn't it? You guys been listening to it? Is it loud enough you can hear it at least? With headphones, it works really good. Yeah, I think you have a little more control of the volume of the headphones too, maybe. So, try that. That way you can sleep easier when you have it. So, okay. All right, anyway. So, thanks for reminding me to do that. What would be the effect on year end? We're doing number 5 on the back of quiz 3 and 4, last page. Okay, anyway, what would be the effect on financial statements failing to record the insurance? And let's assume March 31st first, okay? So how did they record this payment? If you're buying insurance, wouldn't you credit cash? Yes. And what are the two possibilities you could do? You could either debit prepaid insurance. Yeah, and if you paid it in advance, that's a good idea, by the way. Or if you want, you could debit what? What's it going to become anyway? Insurance expense. So either one's just fine. And the kicker in this problem was, I told you they went to insurance expense with the 3,600, didn't I? So where they put the 3,600 is in here. So if we assume that my March 31st date was correct, let's assume that's correct for now. What would you want to do by December 31st? If I put 3,600 into insurance expense, I've got nothing in prepaid insurance. And remember I told you, figure out where you're at, and then figure out where you want to be, and then make the adjustment. Sounds simple, doesn't it? Here is where I'm at, right? I got 3,600 in insurance expense. I have nothing in prepaid insurance. Where would you like to be at December 31st? What should be on the balance sheet in prepaid insurance, and what should be on the income statement in insurance expense? What do you think? The 3,600 was for how long, you guys?
3 years.
3 years. How about 3,600 divided by 36 months? How much is insurance expense every month? $100 every month you use, right? Okay? So if we use 100 a month, how many months went by between March 31st and December 31st? March 31st. We use March 31st. 9, right? 9 months at 100 a month. What do you think? You guys aren't brain dead yet. Come on. You're stuck. Okay, 900. So what account should be 900? It's how much I used. What account reflects how much I used? The expense account. Well, how much did I not use? The other 2,700, right? 27 more months at 100 a month? Shouldn't this account, prepaid insurance, be 2,700? That's 27 months, right? At 100 a month. 2,700. Right? How do you get from 3,600 down to 900? Credit it for how much? 2,700. How do you get from 0 up to 2,700? Debit it for 2,700, which is really handy, isn't it? So the journal entry I'd make is to debit prepaid insurance, 2,700, and credit insurance expense for 2,700. Everybody see that would be the adjusting journal entry? Now, let's look at what the impact of that entry would be on the balance sheet and income statement. So here we go. Okay, prepaid insurance. That would increase assets by 2,700. You guys agree?
Yeah.
We had to know that or we couldn't do the entry. That would increase expense by 2,700. No effect on liabilities, no effect on revenues, right? What would happen to equity, of course? Must be increased by 2,700 too. How did that happen? Increasing the expense. did I do wrong? Oh, it wasn't increasing expense, it was reducing expense. Dangerous. You're right, it would go the other way. Credit to expense does what? Reduces the expense. Sorry. Right? Which should we do what to net income? Increase the net income, which is what increases the equity. Kind of nice to write it down in the accounting equation, because then if you do it, make a mistake, you find it. Okay? Everybody see it? So if this entry would increase assets and increase equity and reduce expenses, increasing net income, what will happen if you fail to do it? Assets would be understated, no effect on liabilities. Equity would be understated, no effect on revenues. Expenses would be overstated. Net income would be understated. Okay? Now, if we assume March 1st, if we assume this date was March 1st, seeing as I screwed up the problem, if we make this March 1st, what changes? Yeah, it'd be 10 months, wouldn't it? Yeah, so if you do that, which is reasonable, seeing as I screwed up the problem, this would be 1,000, right? Okay. Then what? I want this account to be 1,000. And what do I want this account to be? Only 26 months, which is 2,600. So I want this one to be 2,600. How do I get there? Just put 2,600 into prepaid insurance and take 2,600 out of insurance expense. 3,600 less than 2,600 is 1,000. So my entry would just change to 2,600. I'm sorry about that, but I accepted either one of them, which was fine because I don't think very many people got either one of them, unfortunately. Okay? These are just like what I had on the practice quiz, right?
What's another way you can do it is organize expense?
Oh, the other, instead of recording as an expense, they could have recorded it as an asset. What would that be, guys? What would that look like? If they had gone to an asset account, it would have been prepaid insurance, right? Would have the 3,600 in here. That says insurance, okay? And then insurance expense would have nothing. Then you figure out where you want to be. Well, don't you want to be at the same place? Let's use the March 1st date. I want this to be 2,600, and I want this to be 1,000, huh? Assume that's the case. What do you do to make your adjusting entry? I want this to be 2,600, guys. I want this to be 1,000. What do I do? This is where I am. This is where I wish I was. Make your adjustment. Okay? So 1,000 would go here and come out of here. And I adjust from where I'm at to where I want to be. Adjust from where I'm at to where I want to be. That's the adjusting entry.
So obviously, instead of doing it as an expense, I did that gas.
Yeah. So that one word did, yeah.
That's what I did.
So you knew what you were doing, but you didn't read carefully, right? A lot of the problem is that we cover so much, and I showed you how to do it both of those ways in class. But, oh man, there's so much coming at you. What do you have to do? If you do it in class, go find a problem that does it, right? Or practice you on your own, work somewhere with each other. How do you have to do it to get it down? Do it right after we cover something in class is really the best way to go. And then repeat, and then repeat. So it just becomes automatic for you. You get to read really carefully, right? Develop your analytical skills is all we're really trying to do. Okay? So, yeah, these were not easy. These aren't easy questions. Right? Actually, the whole rest of the quiz isn't as hard as 5 and 6. I intentionally didn't put very many points on it because I didn't expect very many people to get them right. Yeah, really. Okay. But can you get to a point where you could do this? What do you have to do? You got to figure out where you're at, where you want to be, make the adjusted journal entry, see what the impact of that entry would be, right? And then figure out what the impact is of not doing it. Well, that's quite a few steps, isn't it? Right? Let's try 6. Number 6 says, what would be the effect on the financial statements of recording payment in full of a $5,000 note plus interest for 9 months at 8% per annum? It's really getting darker, is it? This is going to blind you for a second. Is that better? I'm so excited about life. This is what I had in mind when I went to college. Yeah. Anyway, where I expected to spend my free time. Yeah, I thought when I became a college professor, I'd get to spend a lot of time at home too. This is ridiculous. Okay. Anyway, you know what, you guys? Just think about this. They're paying a note. What do you think you pay it with? Cash, credit cash. Agree with that? And then we'll figure out the amount. What are we paying off? Yeah, it's going to be interest. Time went by, and it says they have accrued no interest, which means they never debited interest expense and credit interest payable, right? They didn't accrue any. So it's going to be interest what? Expense. They haven't recorded it yet. So they're going to give some of the cash they give them is for interest. What's the rest for? Paying off the note, which is called. Don't you debit expenses to increase them? Sure you do. Don't you debit notes payable to reduce them? Sure you do. Don't you credit cash to reduce it? Sure you do. You just got to find out how much. How much note did we pay off? 5,000. I know that. How much interest are we paying on? We're going to have to compute it, aren't we? It's 5,000 times 8%, but that'd be a year. That's $400. Everybody agree? But what portion of a year went by? 9 months. How about 9/12 of it? How much is that? 300. Ta-da, right? And what's really sad is you get to a point where you could actually make this journal entry and then you don't get the rest of the problem. That's really annoying. Okay? So debit interest expense, debit notes payable, credit cash. Does everybody agree that would be the entry? By the way, that's all you're supposed to know right now. Taking it a step further. But you could do this, couldn't you?
You did. How do you know to put the 5,000 note payable? That is good interest expense 300. That's all I've done.
It says, what would be the effect of recording the payment in full? Isn't that what it says? Let yourself relax and read. Maybe you're moving too fast. Read the hard part, do the easy part. Right? But it's a balance of how fast you can do something and how accurately you can do it. Right? You don't want to double check everything or triple check. You know it in a time. But you want to read carefully and work carefully, right? Not slowly, carefully. It's a big difference. Okay? Yeah.
So why is it interest expense and not interest payable?
Because they had accrued none. If they had accrued it, it would have been like this. Debit interest expense? That's a great question. And credit interest payable. If they'd have already done this $100 every month, and there's a total of $300 already in interest payable, right? If they'd done that over the last 3 months, 100 every month, and it added up to the 300, then that would be interest payable. But it said they had not accrued any.
So that just means I haven't made that entry.
You got it. They have not accrued it. Well, that's an accrual journal entry, right? Debit interest expense, credit interest payable. I'm trying to put together way too many things way too fast here, aren't I? But it's going to work, isn't it? It always does. It always does. You just keep working. You keep pounding on it. You keep thinking about it. How does this really work? What's going on? Okay? And it'll happen. And don't sit there and tell yourself, don't do this. Don't sit at home and do it either. Oh, I'm not smart enough. I can't do it. Well, everybody can figure this stuff out. Everybody can. You just keep working at it. And yeah, life's going to turn on for different people at different times. Some things are going to be easier for you, some things are going to be harder for you. I don't mean just classes, that's true too, but even things within the class. Some things are going to just fall in place, that's easy, right? And other things you're going to pound your head against until you figure it out. It's all right. As long as in the end you know what you're doing, right? So let's take, that answer your question though? You got it?
Yeah.
Okay. Here we go, gang. what does this do to that? It just asks what's the effect, increase and decrease. We don't have to worry about what's the effect if we didn't do it. But what does a debit to interest expense do? Increases expense 300, right? That's what we were doing.
Net income,
Decreases net income.
decreases equity,
Yeah.
and then you decrease assets.
Decrease assets, okay.
And everything else like revenue.
Whoops. Revenue's no effect. But liabilities?
Liability decreases.
Yeah. And if you didn't do it right away, you'd notice, wouldn't you? Because these two have to add up. So that decreased liabilities by 5,000. So what was the answer, guys? Reduce assets 5,300, reduce liabilities 5,000, reduce equity 300, no effect on revenues, increase expense 300, which reduces net income 300. Boom. Okay. Not very many people got those two, but it's okay. You will on the test, right?
Yes.
Have it down. Let yourself think through it. The other thing is you don't need to panic, you guys. You just need to get so you can do one problem, and then you get so you can do the next one, get so you can do the next one, get so you can do the next one, right? Like that. Okay. There's still plenty of time to get these solved. Because you sort of understand already. Everybody who's been working sort of understands. Get it solid. Okay? Got a bigger sort of work on it. So what do you want to do? You want to do some from chapter 1 and 2? Quiz? Is there any on there that would drive me crazy? Or are they just feel simple now? After we move.
Yeah, copy that.
Which one?
1, 2.
Actually, that's cool. I have some for both of them. Here's a 1 and 2. Anybody else need a 1 and 2? A blank one? They're kind of handy to study from. We've got 1 and 2. Another 1 and 2. Usually we do it without having a blank sheet, right? It's kind of nice. Anybody want a 3 and 4? Redo it. You go. Okay. Excuse me. So we can work some from quiz 1 and 2 if you want. And if there were some that are still driving you crazy.
We go with that part.
The back part of it. Sure.
I mean,
And you know, these are really similar to what's in that test 1 through 4 that's out there online, right? You did work that over the weekend, didn't you? Study. Right. Don't get discouraged and not do something. That's human nature too, right? Something doesn't go well, so we quit for a while. Right, that's a recipe for disaster. You know, things move so fast in these classes that if you quit for a while, you can't quit. You don't get to come back in very, very easily. So don't get discouraged, just work, okay? Just keep going. Life's awful, it's work. Okay, 39 through 45 on the first quiz. The second quiz was short until you did it, huh? About the same thing, really fun. The Superior Company has provided the following asset and liability accounts. Okay, the beginning balance in contribute cap was $150,000, and the company issued $50,000 in common stock for cash during the year. Okay, so that's what we've got. So we know what the equity looks like, I guess. And then we listed a bunch of accounts, and the thing here is, I put them pretty much in order. Will, do you think I'll always do that? No, I'll probably put them in alphabetical order. Drive you crazy. So what would you have to do if I put them in alphabetical order? Go through and identify which ones are current assets, which ones are non-current assets, which are current liabilities, which are non-current, what accounts are equity. And, but in this case, it's fairly straightforward, but you had to know what's current and what's non-current, didn't you? It wants current assets. So which ones are current assets? Let's just label, let's go through all of them and label them, because it wants current assets, current liabilities, total assets, total liabilities, and then total equity, contributed capital, and retained earnings. By the way, you can set it up just like this. Is this redundant or what? And it once contributed capital and retained earnings separately. So, and the assets are gonna be current assets and non-current assets, and the liabilities are gonna be current liabilities and non-current liabilities. And then the equity is all non-current, of course. Okay? The others aren't taking their money out within a year. Oh, I just gave it away. What makes an asset current?
Use it within 1 year.
Use it within 1 year. Or it's cash. Yeah, okay. Yeah. You're gonna use it within 1 year. The criteria is 1 year. What if I'm gonna use it in more than a year? A note receivable is gonna get paid to me in 1 year and 1 day. Long term. How about just 1 year exactly? Current. Ridiculous. I mean, it's just not arbitrary cut off. How about on payable? What's the current liability? I'm gonna pay it within 1 year, or if it's unearned revenue earned. That's it. What if I'm gonna pay it in more than a year, 2 years, 3 years out? That's long term, non-current. Got it? Okay? So, cash. What is cash? It's an asset, current or non-current? Current, sure. Cash is about as liquid as you can get, right? So I put CA next to cash. That's what I did. No kidding. Short-term investments. Short-term, current. You're gonna sell it in a year. That's definition of short-term. Current asset. Accounts receivable. I hope they're current, right? They could be non-current if I give them more than a year to pay, but almost always current. Current asset. Inventory. Let's hope I'm gonna sell it in less than a year, right? That's a current asset too, isn't it? Long-term notes receivable. Non-current. Equipment. I hope my equipment lasted more than a year. Automobiles, trucks, building, that's not good. Automobiles, trucks, machines, yeah, sure, that's non-current. Factory building, non-current. Intangible assets, non-current. What about accumulated depreciation? It's on the buildings and equipment, it is non-current, okay? How about accounts payable? That's current liability. How about accrued liabilities payable? Salaries payable, rent payable. Current liability. How about a short-term note payable? Current. How about a long-term note payable? Non-current. Now you feel ridiculous if you miss this stuff. All you had to do is go down 2 rows. Oh yeah. There were a couple people got 30s on this thing, so yeah. This looked hard, but it wasn't, was it? Just relax.
What would be the total equity?
Well, let's do it this way. Let's get total current assets first. What's 152 plus 18 plus 36 plus 116, guys? Those are the 4, right? Everybody agree? I got 322 for that. Is that what you guys got? 152 plus 18 plus 36 plus 116. You staying with me? And then let's do the long term. 44, 174, 270, and 33. Is that 521? Is that right? What's total assets then? 843? Is that right? Okay. Everybody see what I did? I just added up the current assets, I added up the non-current assets, and I added them together, and I got the total assets. I think it's 843. 322 plus 521. Are we good? What do we know about the current liabilities? What are they? 130 plus 19 plus 84? 233? What's the non-current liabilities? 169? Just in one note payable, right? What's 233 plus 169 for the total liabilities? No. Equipment's non-current. Right? Equipment? You can use it up in less than a year? Equipment? Trucks? You buy automobiles that last for less than a year? You might keep it for less than a year, but it doesn't last less than a year. Right? Boy, wouldn't that be awful? $40,000 for a car in less than a year. No. Okay. So my wife used to buy cars every couple of years. But since she started taking care of the grandkids, she now has an old Volvo. There's no way. There's no way. Anyway. So now she's talking about she's gonna go back to work now that they're getting older, so she can have a new car. A car, anyway, yeah. So what's 233 and 169 add up to? 402? Yeah. What's total equity? You asked about equity, didn't you? What's total equity, you guys? 843 less 402 is how much? 441. This is where the problem suddenly got harder. Okay? And what's that composed of? Yeah, those two added together, it is, isn't it? Yeah. So what do we know? This is their first year of business. So they start with nothing. Good. They're going to be credits. Or is this?
Beginning balance and contributing capital.
Oh, I lied. Oh,
50,000 common stocks, we knew it was 200,000.
I lied. Beginning contributed capital is how much? It was 150 plus they put in 50 more. Yeah. So it's 200. Exactly right. Okay, thank you. Okay, so it's 200. So what's retained earnings then? 441 less 200, right? Must be 241. Good. Did I give you a beginning retained earnings? No. So what could you do now? Can I get net income? No. Can I get beginning retained earnings? No. Can I get dividends? No. There's three unknowns here, right? Dividends, beginning, plus net income is 241. But I don't care, do I? Because what did I ask you for? Current assets, what are they? 322. There's the first one. Current liabilities, 233. Total assets, 843. Total liabilities, 402. Total equity, 441. Contributed capital, 200. Retained earnings, 241. I don't need those amounts. Could I expand the problem though and solve those two? Sure. So the hard part was getting probably in the retained earnings, equity and retained earnings. The rest is pretty easy. Everybody good? Did I do it? Are there more on that one you want to do? You guys do know how to increase and decrease accounts, I hope. Want to do something to test or some more from this? Something like that. If there are more on them, I'll.
These 30.
Number, what is that, 4, 5, or 6 or something?
2, 3, 4.
2, 3, and 4. 2, 3, and 4 from the test. Here is the test. View dual page display. And then let's oh, come on. Knock it off. That might work okay. This is test 1 through 4 from summer. So you want to do 2, 3, and 4. Yeah, that'd be fine. Okay, what would be the effect on the financial statements of recording the purchase of a forklift? Or they make a down payment of $4,000, 6-month note, 10% interest for the balance. Life is 4 years and a $4,000 salvage. Straight line depreciation will be used. The truck was what? Purchased January 1st? Okay, thank you. And the company's year end is December 31st. For each type of account, indicate the dollar amount, increase, decrease. Okay, so exactly what's the deal here? It's a truck that we purchased, and what was the total amount of the purchase price? 20,000, okay? 4,000 down. So let's record the entry in the first place to buy it, okay? So they say, what would be the effect of recording the purchase in the first place? What about the interest on the debt? Does that have anything to do with recording the purchase? No. Interest expense happens as time goes by, right? Not on the date you recorded it, the purchase. What about depreciation? No, that's as time goes by too. There's no depreciation yet. So what do we have to worry about? Just recording it. So what did we get? So we'll call it equipment or forklift or something. For how much? 20,000. What do you want to credit? Yeah. And yeah, I think so. And the first question is, what's the impact of that? I know you guys can get this right. You just relax. You know, students often say, well, you gave me too much information. Think what real life is like. How much information there is, or at least data. Only information is understandable. Data, stuff coming in. How many pieces of information do you have? And you have to sift through them and take the ones you need, huh? So this is sort of the beginning of that. I don't care about the depreciation or the interest yet. I care about that later, right? But not now. That's the entry. What does this entry do? What would be the effect of recording this purchase? I will have more equipment by 20,000. I will have less cash by 4. What's the net effect on assets? They went up by 16. How about liabilities? Increased by 16. Does anybody see an equity, a revenue, or an expense there? I don't. No effect, no effect, no effect, no effect. I'm done. That's number 2.
All that other stuff is just there, and then stuff that.
Well, we're going to use it later.
Like
How much depreciation, yeah, the next problem. How much, I think, isn't it? Yeah. How much depreciation is there the day you buy it?
0.
Yeah. So what would be the impact of depreciation? Nothing. How much interest is there the day you borrow the money? 0. Or the moment you borrow the money. The day it is actually, but the moment.
My grandpa said that when you buy a car, and then you drive it off the lot, it loses value.
That's true. But we're not, that's a good point. We are not reflecting change in value. We are reflecting change in market value. We are changing utility value. My Miata, I have no idea what it's worth. It was manufactured in 2000 or 2001. So it's 13 years old, maybe 14 years old. It's got 75,000 miles, 76,000 miles on it. So how much is it worth? I don't even know. I don't care. I think that I can probably drive it till I die. It'll last as long as I do. I'm only putting 1,500 miles a year on it. How many miles will it be in the next 30 years until I'm 93 years old? And God forbid, I'm still driving that at 93, right? Okay, I'm pretty bad now. You know, so at 93, you probably don't want me out on the road, huh? You guys will take my license away from me. How many miles is that going to be? 30 years at 1,500 a year. It's 45,000 miles. How am I going to be used up yet? I care about the utility value of it, not its market value. I'm never going to sell it. So when UPS buys an airplane, do they care what the airplane's worth, or do they care how long it's going to last? When you sell it, you care how much it's worth. You know, if you get, you know, a truck, you know, at the end, if you can get 2,000 for it instead of 500, you care. But that's not the big issue. You bought it for 40,000, right? And you're going to use it up. So it's depreciation reflects utility value. That's a great question. Okay? But you know what? Your grandfather was is right. When you drive it off the lot, don't ever buy it back. When you drive it off the lot, the value plummets. Unless you're going to do what? you really love the smell of a new car, you love the feel of a new car, and you were gonna keep a new car, 10 years. That's not bad, it's all right. Still crazy, you should have bought one for a year old for 70% of the price that you paid for the new one. It has, almost as many miles on it, it's a far better deal. But then you have somebody else's car. My wife likes what? New. I always tell her I'm rarely lucky, but the only thing she doesn't think you need new of all the time is husband. New, yeah. She'll make really wonderful dinners and I eat all the leftovers. But she doesn't. Stop. New, yeah, it's funny, hilarious. I tease her a lot about it, so. All right, so let's do the second one. What do you think? Oh, that didn't work. Okay, anyway. Try this.
How do you know, there,
Like not to calculate your interest
And depreciation. We just did this. This time pay attention. Okay, yeah.
it says at the year end, so you're in a year, you want to.
Well, yeah, but what is the question on?
Well, the interest statements and before you purchase it for $20,000.
Yeah. So what question did we just answer?
That one,
Yeah. So why would you care about the depreciation of the interest? Yes.
I'm sure I would have does.
But you don't care. Look at it, what's the next question?
What will be the effect on the note, take another note?
Yeah.
Well, I don't read them, but.
That's what happens. It's what it says, huh? Is it really easy to have a whole bunch of extra information in a problem and have it screwed up? Yeah. Have you taken tests that have done that to you before? Yeah. How do you get so you don't? Read the requirement really carefully. That's really the trick. Like you said, I didn't read it carefully.
Yeah.
And what happens, you got so much pressure on, so you get such a big hurry that it all blends together, doesn't it? Let yourself relax and use what you know. When I want you guys to panic is when you're deciding whether you're going to play or study. And then I want you to be real panicked if you go play instead of study, right? That's when you use the panic. When you come in to do the test, just relax. If I ask you questions you can't do, trust me, the people who are not coming to this review session can't do the stuff you are actually going to be able to do. Relax. The competition's giving it to you. Okay? Right? So relax. All you have to be is more prepared in your competition. You don't have to be perfect. That's in between the work too. So yourself relax and do it. Right? For some of you guys, it feels kind of new not to be making 98% on everything, right? I always get 98% or above, right? No, it's not the way it is. I remember in the Olympics when they started giving all the gymnasts 10s. And you know who complained about it? The gymnasts. Why? Everybody got a 10. What kind of competition is that? It's like having every football game, both teams get 100 points. And then you go home. Well, that'd be nice if you're 4 years old and you don't want to have anybody win and anybody lose. But it's not the way the real world is, right? People compete. So relax. If you're getting 80% of the points, wow, that's good. That's an A, right? If you get 75% of the points in the CPA exam, you know what happens? You pass. Bar exams are that way. Medical school exams are that way. You pass. And you're in, right? You're on your way. Your career's taken off. So let's do the second one. What would be the effect? I'll explode that for a second. What would be the effect on the financial statements of recording the payment of the note in problem number 2? Now, what do we mean here? How long was this note for? 6 months. You everybody see that? I think it won't let me write on it. I thought it would. But 6 months, right? 10% interest, okay? So we're going to pay this thing, and they bought it January 1st, right? So we're going to pay this thing in 6 months. Let's figure out what the entry would be to pay it, okay? What will the entry be to pay it? And then look what the impact is on the financial statements. So what are you paying off? Yeah. Debit, note payable. You guys agree with that? Because we're paying it. How much was the note? 16. 4 was the cash. Yeah, okay, debit notes payable. What are we paying it with? Credit cash. Just need to figure out how much. And what's the other thing gonna be? We're incurring interest. And we won't have accrued it yet, so it's gonna be debit interest expense, right? We accrued it to be interest payable, so this is gonna be interest expense. Okay? How much interest expense? How much should we borrow? 20,000 or 16? It'd be easy to take the 20, wouldn't it? But that's what the equipment was. The debt is only 16, isn't it? Right? So 16,000. What's the interest rate? But that would be for a what? Year. Okay, so we'd pay 1,600 in interest if it was a whole year, but it's not a whole year. What is it, gang? It's half a year times 6/12, so only 6 months went by. I think that's $800, and we have it made. Debit interest expense 800, and credit cash how much? 16,008. Okay, now what's the impact of that? What's the impact of that on our accounting equation?
Your, assets.
You know what, you guys just do it. Take this and do it. You just wrote the entry. You know what it does. Don't you? Write it in there. Do it on your paper. Can you do it? See if you just relax, you can do this. Okay. Can you get that journal entry? Can't you? You know how to calculate entry. You know what it counts as that? We had to do the journal entry. You know what the impact is on the balance sheet? Yeah. Get it right. Just relax. Panic and just wipe you out. Everybody knows that from sporting events. You just do, don't you? You know it from previous classes you took? Remember the first time you had to stand up in front of a class when you were 6 years old or something? How panicked you were? You know, just practice stuff. Keep doing it. So, take it in stride. Notes payable is our what? Liability. Debit does what to it? Decreases by 16. Interest expense is a expense. Increased by 800, right? No, this is 16,000, I guess I'm there. Okay. That would make net income go down by 800, which makes equity go down by 800. So it must be assets went down by how much? The two added together, 16,800, which of course is how much cash went out. Revenues? No effect. Got it? You could do it, couldn't you? Okay, if I fail to record this, what's wrong? Let's change it a little bit. What if I fail to record it? It wasn't fail to record, was it? No. What if I fail to record it? What would be wrong with assets? Overstated. Liabilities? Overstated. Equity? Overstated. Revenue? No effect. Expenses? Understated, causing net income to be overstated, which was what caused the equity to be overstated. We can do it, can't we? Okay, so let's take a look at number 4, I guess. What would be the effect on the year-end financial statements of failing to record depreciation on the truck purchased in problem number 2? For each type of account, indicate the dollar amount. Yeah, blah, blah. Okay, so this is going to be a failing to record it. So this is going to be the over-understated thing, isn't it? So depreciation. So what's the deal with the depreciation? Straight line, that's handy. Later that's going to mean more to you. That means they take the same amount per year. Okay? And what else do we know about the forklift? It costs us how much? Thanks for coming. 20,000, right? And how much are they going to depreciate it down to? The salvage or residual value of 4. So I'm going to depreciate how much? 16, right? Okay, I'm going to depreciate 16. I shouldn't have made it the same as the debt, but anyway, I did. 16. Okay, and how many years? 4. So I got 4 years. What day of the year did I buy this thing? Yeah, January 1st. What if I had bought it, say, March 31st? And my year is December 31st. I'd only depreciate what? 9 months. Here, what am I going to do though? I'll depreciate how many months? All 12, because I bought it the first day of the year. Everybody good? So let's do it. So I have an asset that cost me $20,000. I have a salvage value of $4,000. I'm going to subtract that because I'm only going to depreciate it down to $4,000, right? When my accumulated depreciation is $16,000, I will quit depreciating. So I have a cost of 4, equipment of 4, less accumulated depreciation of 16 at the end, and I'll have a 4 remaining salvage value. That's what I think I'm going to sell it for at the end. That's my guess of what I'm going to sell it for. Okay? So my depreciable value, we're going to call it is 16,000. We'll call it that later. Okay? My life is how much? 4 years. Guess how much you're going to depreciate each year? $4,000. Right? Per year, depreciation. So what I'm going to do is I'm going to debit depreciation expense, right guys? Increasing that expense because I'm using it up and I'm using that piece of equipment up, generating revenues for my company. So it's a cost of generating the revenues, it's an expense. And what am I going to credit? Accumulated depreciation. We don't directly reduce equipment because the equipment's not really going away. We are reflecting that we are using up its utility value, right? And accumulated depreciation is a contra asset, so it has a credit balance. Got it. Okay, good. Yeah, I know. It's going to be fun if you find out I did it to you, too. I like that. Okay, anyway, so. It wants to know what the impact would be of failing to record that entry, guys. So what would the entry do? What would a debit depreciation expense do? Yeah, what else?
Increase net income.
Okay. Which? And decrease the assets. A credit to a contra asset increases it, but it reduces your asset, right? We just reduced the asset from 20,000 to 16, right? Because we have equipment of 20, less accumulated depreciation of 4, it's now 16. Good. Went down by 4. How about liabilities? There's no liability in that entry. How about revenues? There's no revenue in that entry, and we're done. Okay? That's what it would do in terms of changing, but it wants to know what would be overstated or understated if you failed to do it. What would be wrong with assets if you failed to reduce it by 4?
Overstated.
Overstated. No effect on liabilities. Equity? Overstated. Revenue? No effect. Expenses? Understated, causing net income to be overstated. Yes?
Just a quick question, but why would you put the depreciation in the expenses?
Okay, I bought the piece of equipment to use it generating revenues, the truck, the product equipment, right? Okay, I bought it to generate revenues, right? All the costs associated with it must therefore be expenses I incurred to generate the revenues. So interest on the debt, interest expense. Depreciation on the truck, depreciation expense. Gasoline that we put in the truck, fuel expense. Repairs, changing oil and changing tires and stuff. Repair expense. Did that do it? Okay, it's there. So you always think about, why am I incurring this cost? If I'm buying an asset, I'm going to use in the future, I debit an asset, right? Let's say I'm repairing, let's say I buy a really old truck. It's got 200,000 miles on it, and I put a new engine in it. I wouldn't debit expense for that new engine. I would debit the truck for that new engine because it makes it a better truck. We'll do that later. But what if I buy a brand new truck? I drive it 200,000 miles. Now I get it. Okay. What if I change all the tires on a semi tractor trailer rig out there? Costs a fortune, but it's just maintenance. The repair and maintenance expense. So it'll get more complex. but the concept's still the same. You got it? Okay, good. It's a nice insight. Okay. So what else do you guys want to do? Was that the end of that series? It was, wasn't it? You want to do some more from this test? Are we sick of these? Here's Bellarmine and University companies. You guys know how to do these? Beat it to death. Practice, practice, practice. Okay. Again, can you do it if it looks like a little bit different format? Right? What is what? Oh, what is a deficit? What's a deficit retained earnings? That's great. What would a deficit retained earnings be? Great question. Okay, take a look at this. Deficit retained earnings means it has a debit balance. How do you get a debit balance in retained earnings? See, we start the business with nothing, right, at the beginning? And then what do we do each year? When we close the books, what happens? We increase retained earnings by your what? Net income. Year after year after year. Everybody agree with that? What happens if you lose money? You have a net loss. You debit, wouldn't you? Each year you have net losses, you debit it. You guys agree with that? So all my net incomes over all the years I'm in business get added to retained earnings, and all my losses over all the years I'm in business get taken out of retained earnings. And what else comes out of retained earnings? You don't have to retain it. What could you do? Dividends. Yes, you could pay a dividend. So all the years that you declare dividends, they come out of here. So you guys with me? So if you look at retained earnings for a company, it is the summation of all their net incomes for all the years they've been in business, less all their net losses, less all the dividends they ever paid. My equity is what I started with was nothing when I started the business, plus everything I've earned over all the years, less everything I've lost over all the years, less everything I've taken out, which is the dividends over all the years. Is this common sense or what? Right? That's what I'm worth. Okay? That's what I've retained. Retained earnings, I kept it, right? What you'd like to have is a really big credit balance over here, right? Because your net incomes over the life of the company exceed the net losses and the dividends. What would a retained deficit mean if you have a big debit instead of a big credit? What does this mean? It means over the life of the company, your losses and your dividends are bigger than your net incomes. General Motors, when taxpayers had to bail them out, the government bailed them out. Thank goodness we did. General Motors still exists. Right? There's a lot of jobs. And besides, we got paid back the money. Not only didn't we kill the company, but we got paid back the money. Too big to fail is too sad. But at least we saved them, right? Those jobs are still there. Of course, they make cars with faulty ignitions, don't they? Yeah, crazy. Okay, anyway, I can't believe they did that. What does the debit mean? It means you're close to bankruptcy, huh? They had a debit balance, been in business for a long time, but they had a debit balance and retained earnings. They'd lost everything they'd ever made. Yeah, that's what bankruptcy is. Think about what happens with bankruptcy. Assets equal liabilities plus equity. What if this is $100 million and this is $150 million? What's this? That's a debit. That's a credit. What's this one got to be? Debit of 50. It's called being bankrupt. You've lost everything the owners invested at the beginning, plus 50. If that's guilty, you can still attack your company. Right? They cease to exist. The creditors now own the company. The people who have this debt, that hold this debt, right? They own all those assets. They force you to sell them, and at least they get the 100, right? And they lose only 50 on the deal instead of you losing even more. So they take over the company. That's bankruptcy. Okay? Good question. What else do we want to do? You guys aren't getting tired, are you? I'm 63 years old. Come on. You guys can work, can't you? Nice to be here. Okay. I walked 6 miles this morning too with the dog. Yeah.
Can we go with the number one, please, just because?
Yes, we can. We can do another one. Just because we love doing these. No, I'm kidding. Well, I guess we love doing them. We must, we're doing it. I'll make it a little smaller so it's not in our way. You do these things enough times and, well, actually what happens, you do them enough times, you start making ridiculous mistakes, but we won't talk about that like I did today. So anyway, there it is. And that. Okay. Yeah, let's do this Bellarmine Company. Now again, really concentrate on what you're doing versus memorizing doing it. Does that make sense? Be real careful with that, because we're doing too many problems that look exactly like each other. And make sure you're really getting the idea of what you're doing, okay? So if you just look at this, I gave you 2 different years, 2011, 2012. I highlighted them, just because it's easy to switch them, right? So maybe I should always do that. But if you look at all these accounts listed here, what would you think? These are balance sheet and income statement accounts, right? So a way you could approach this is to do financial statements. You can work it without writing down the accounting equation. I just think it's really a pain to do it that way. Take forever. So you don't have to store anything in your head if you do it like this. Assets equal liabilities plus equity, right? Revenues less expenses. Net income. And I know when I look over here, I see, oh, well, he wants contributed capital stuff, and he wants retained earnings type things, right? So I'm going to have to split this into the 2 types, contributed capital and retained earnings. So I'd set it up that way to begin with. And then, there's a beginning balance and an ending balance. I got 2 years I'm working with. So in the first quiz, we didn't have a beginning balance. They were all zeros. That's all it really amounts to. But this time I'm going to have to do both. So give it a shot. Go ahead and do it, and then we'll do it. Okay? Give us a shot. Write down everything you know. Get it set up in a template like that. Okay? Accounting equation. And then write down everything you know and see how quickly you can work something like this. And what you're going to do is you're going to solve for the things you don't know. That's the trick. So go ahead and do it. I already did it. Good. Pays off, doesn't it? These get easy, don't they?
Helps a bit, yeah.
Yeah. Then you just have to not panic when you do it. Just relax.
They're not supposed to win.
It wasn't much of basketball. God getting being too greedy at basketball. It was more of a special.
Well, back up quarterback, I think he's not about. He's a true freshman.
I think the kids are playing quarterback for him, play pretty good. I think the defense does a job.
Men's stress teams, they bump that.
Oh, yeah, I mean,
They wouldn't bump that front every one.
you can't expect, the quarterback they got starting was 93. The older than him was that. That was ridiculous loss. I think he just got a letdown. Oregon was behind 7-0.
Yeah.
You know, against Wyoming.
Don't blame you.
They were only a 40-point favorite. They were behind 7-0 at the end of the first quarter. Of course, then they scored another 6 drives.
Well, a lot of people think I thought they didn't even think they would cover the spread at this point.
And I was surprised it was that bad. I was pleased with it.
It's a horrible coach, they have top 10 talent.
They have a good coach now. Yeah, they're coming out. But they're not a winning tradition. Hard to believe they're going to win. They might believe it now after that. They can get it, you know. You guys get the number.
How much do we get?
$20, or $20.
You saw it, class, $20.
You don't even want to spread, but it was, please. That's a thing. That's a thing. I'll give away $20 for free on that.
Not giving it away.
You don't have to pay it before the game, right? You guys got the answer? It's easy? Let's do it. Where do we put the numbers? Ending retained earnings goes where? How about the end of retained earnings? Why am I putting on the right-hand side? It's an equity account, right? Okay, everybody knows this by now. Bad thing is, before you know stuff, you kind of just stare at me, and then after you do know stuff, you just stare at me. So, yeah, either way. Liabilities, ending is 190, right? Right. Expenses, 90. Everybody agree? Let's see, assets start out at 390. Assets end up at 400. Everybody good? Let's see, revenues are 115. Dividends are 10. Dividends come out of retained earnings, right? Okay, good. Contributed capital at the beginning is 9. Okay, is that everything we've got? Okay, so what can we solve for? Net income, what is it? Okay, then what? Net income goes in here, right? Okay. What else do you want to do? You can solve for equity up here, can't you? What's that? 400 less 190 is what? Okay, we can get that. Now what? You solve beginning retained earnings. If you know the ending is 35 and you know you added 25, you know you took out 10, so the net you added is 15, and it's now 35. What was the beginning? 20. That was 20. Got that one. What else can we do?
I always get confused. What do you do with owner investment? Like what
Oh, did they have an owner investment this time?
We don't know.
Oh, we don't know. We don't know what it is. Yeah.
What category does that go in?
That goes under contributed capital. It's more. What we do is we would debit cash if they contributed cash, and we would credit common stock, right? Which is the contributed capital account. This is the contribution of capital. Or it might be debit, land, contribute, credit, contributed capital, sometimes. But that's the entry, right? And you know that entry, okay? So that's what we're saying, is what is this number? Is there something else we can solve? Can I get liabilities? Can I get equity? Or can I get ending contributed capital so I can back into contributed capital? What do you think, guys? I can get ending contributed capital. How can I do it? 210 less 35 must be the contributed capital right now. You guys agree with that? What's 210 less 35? this is 175. Now, so I have ending contributed capital. Now what can I do? Can I get how much got contributed? If you started with 90, right, and there's 175 at the end, how much got contributed? 85. Must be the contributed capital is 85. Okay? And I need one more piece, I guess. I need beginning equity so I can get my liabilities. What's my beginning equity? 90 plus 20 is how much? 110? Did I do it right, guys? And what's the beginning liabilities? 110 away from 390 is 280. How many of you got all those? Ouch. Oh, you too. Can you do it? Do the other one. Let's do the other one. Okay? It's all right. Once you get it, and you see it, these are going to fall out. All right out. And you get to do it on this test, and you get to do it again on the final. Okay? And actually, if you know it, it's going to help with everything else we do in between. You know, all those relationships. Yeah, the practice test. First problem. Everybody just loves doing this. Solve for the unknown type problems. You could do it wrong. Maybe I did it wrong. Figure it out. Discipline yourself to write everything down first, and then you take a step back and look at it. And just ask yourself, what can I solve? And then piece by piece by piece. First one that happened was, what was I not solving that in the air, right? But it's constantly not being these, and what we'll do is we focus on this stuff, oh, I can't do it, can't do it, can't do it. Okay. So we need to know each time we solve it, it opens up another door. net income or less net loss, right? Less dividends is there. Yeah, dividends, net loss. This one's kind of hard because of the deficit. It's true. You guys can be doing this in 15 minutes. Let's grab it. I got that cafe over downstairs.
I got 60. I'm not really sure. I got 60. On a decade.
guess I could have put the recorder on pause. 10 minutes of silence.
That's what we're doing.
Everybody got an answer? Everybody?
How do you get dividends? That's the only thing I'm stuck on.
If you know equity in total, you know contributed capital, you can get ending retained earnings. You have beginning and ending retained earnings. Gave you beginning, I think, right? And then if you know the net income or net loss, there's only one unknown left, right? If you think of retained earnings, the beginning in this case is a debit, right? Because it's a deficit, right? So the beginning is here. How much was the beginning of retained earnings? 20 deficit. It's a 20 debit, right? And then do you know the ending by now? And then the dividends would come out of there, and net income would go over here, or the net loss, one or the other, right? So if you had your beginning and you had your net loss or your net income and you had your dividends, you'd get the ending, right? What you're trying to solve for is dividends. So if you knew this one of those, you knew the beginning. This one.
How about 20, looking here towards the ending?
Oh, it's ending. Oh, I'm sorry. So I'm solving. I had to solve this one. Get this one. Let's go ahead and work it though. But does that make sense? Just what happened to retained earnings? Maybe it doesn't make sense.
It's beginning and just like,
Let's try it. Okay. Let's give it a shot. Assets equal liabilities plus equity. Feel like you've always known this, huh? That's good. Okay. Here we go. I know that the beginning contributed capital is 150, right? Everybody put that there? Okay. Net income for the period is 60. Positive net income, right? That's a 60. Okay. Increased your retained earnings, didn't it? Okay. I know the beginning liabilities are 620. Okay. Don't know the ending. I know ending retained earnings is a deficit. Thank you. Of 20, right? That's the ending. Debit balance. Okay. What does that mean? My losses and dividends over the life of the company have exceeded my net incomes over the life of the company. So usually when a new business starts, they lose money from the beginning for the first 5 years or so. So they almost always have a deficit retained earnings at the beginning. Owner's investment was 10. So we started with 150 and they put 10 in. Everybody good? Okay, that's the contributed capital for the current period. Expenses are 400. Okay, beginning assets are 710 and ending are 620, is that right? Okay, now when we get to this point, let's step back and try to figure out what we can solve. Can you solve for beginning equity? Yeah. 710 less 620, how much? 90. Total is 90. Can you solve for liabilities and equity? No, there's two unknowns, can't I? Can I solve for, let's see, revenues? No, there's two unknowns. Can I solve for net income? No, there's two unknowns. I gave you net income? Oh, I lied. It's 60, so I guess I can. Okay. So, can I solve for revenues? 460. So I got that one now, don't I? Okay. Now what? What else can I solve? Maybe beginning retained earnings because you have what? Contributed capital 150 and 90 of beginning equity. So what's retained earnings? It's a debit, isn't it? How much? 60. They were in the hole 60, right? Everybody agree that 150 less 60 is the 90, right? Okay, so if I start out in the hole 60 and I earn that income of 60, what happened? That made it 0, right? 60 debit, credit 60, that made 0. Now I'm broke even, no deficit anymore. So what must my dividend be if I have a deficit of 20 left? Dividend's got to be 20. Oh, now I've got my dividends. Okay? What else have I not solved? How about any contributed capital? Can you do that one? Could have done that all along, huh? 150 plus 10 is 160, isn't it? Now what can you do? Ending equity up here, what is it? 160 credit, less a 20 debit, it's 140. What's liabilities? 620 less 140, how much is that? 480. 480. So they're starting to get this company in better shape, aren't they? Right? So how many of you did that one? Practice, practice, practice. Got it? Okay. Maybe there's a retained deficit got to. Okay. Are there more? Good ones in here? What else don't you know how to do? I know how to do everything, right? Sure. Want to do a bunch of journal entries? Number 5. It's a monster.
These aren't adjusting,
These are both, aren't they? These are transactions, and then down at the end, what entries would you have to do? So yeah, these are kind of tough. Let's see, how come it's not letting me write on this? Oh, now it is. Good, okay. I'll put them right here. Store company. My wife's maiden name. Huge family. Got a lot of stores around on the West Coast. Store company, a lighthouse consulting company, that's what she elects. Completed the transactions given below. Company prepares financial statements every month, and the company's year end is December 31st. We're going to use this December 31st, and it matters that it's every month, guys, right? Because you're going to have to make monthly entries. Okay? All right, so on January 20th, they issue capital stock to a new shareholder for 10,000 cash. What did they get? Go ahead and write. What's the entry? Debit what? Cash. What's the credit? Common stock. Nothing to it. Okay? You're going to get those points, aren't you? Okay? January 31st, we received 12 months written advance on a warehouse. What do we get? Well, they prepaid it. We received it. What'd they give us? Somebody paid the rent in advance and they gave you the rent in advance? What is that? What did they give you? Cash! You guys going brain dead on me? Like me? I haven't earned any yet, so I guess I owe them the use of the building, don't I? Unearned revenue, of course. Excellent. Which is a what? Liability. Sure, you have more. Excellent, excellent. Okay. Record any entry necessary related to the warehouse rental. And this is February 28th, and we bought it January 31st, right? Or, I'm sorry, we received the cash January 31st. 1 month has gone by. That was 12 months rent. What's 1 month if this is 12 months? I think it's 3,000, don't you? When you divide 12 into 36? 3,000 a month, isn't it? So how much have you earned? 3,000? Does everybody agree with that? And we paid you 36, it's for a whole year, a month went by, right? So now you've earned it, haven't you? 3,000 of it. What do you want to debit? Unearned revenue, because you don't owe them the use of 1 month now. It's gone, isn't it? You guys agree with that? So now it's only 33, so 36 less 3, right? You only owe them 33,000 of rent, right? Rent. 11 months. And what would you credit now that you've earned it? Rent revenue. Yeah. This repetition does pay off, doesn't it? Sink in, sink in, sink in. Okay? Put in the time you need to really understand stuff, you guys. It'll make your life so much easier. It really will. And do it while you're working, just keep working until you got a particular idea. Then take a break and go do another plot when you come back, right? Then take a break in the middle of one. Get it done, get it done. Okay, February 28th, paid management salaries for March. I'm paying for March, it's February. What do you want to do? What do I give them? Cash, so debit or credit? Credit, of course, because cash is an asset, it went out. Excellent. If it was for February, I would debit salary expense. But it's not, it's for March, so what is it? Of course it is. It's prepaid salaries, it's an asset. Very good. It's easy, isn't it? Just relax. Record any entry necessary related to the management salaries at March 31st. What happened in March? They worked. You got the benefit of their work. You used up the benefit. What does it become? Yes, salary expense. I'm earning revenues with it, but this is expense side, right? So it's going to be salary expense. Excellent. How do you increase expenses? With debits. Wonderful. And what did you use up? I'm not paying them again. Yeah, the prepaid salaries is now gone. I used it up. Oh. What if I was paying for this month? It'd be debit, salary expense, and credit cash, right? Like we said, that's one way of getting salary expense. What if I'm using up a prepaid? It'd be debit, salary expense, and credit prepaid salaries. What if they do the work now and I'm going to pay them next month? What would I do? Debit, salary expense, and credit what? I'm going to pay them next month. Yeah, salary and wages paid. Debit, salary expense, credit, salaries paid. True? Those are the three ways you can have salary expense. You can either pay for it at the same time, or you can pay for it in advance and then use up the prepaid, or you can pay for it later. For the expense now, record the expense, and then pay for it later, right? This, by the way, is a deferral. Let's see. This one right here is a deferral of revenue, right? Putting off recognizing the revenue until I earn it, right? This one right here is a deferral of expense. I'm putting off recognizing the expense, right? Until I use it up. That's it, isn't it? Okay, so let's do F. I purchased a computer for $12,000, paying $3,000 down and signing a note for the remainder. The note bears interest at 15% and is due May 31st, 2008. So it should have been 2018 or something. The computer has a 3-year useful life. That's a typo. Can't be before the 2012. The computer has a 3-year useful life and no salvage value. It will be depreciated in a straight line basis. Okay? So what would we do with that? April 1st, 2012. Purchase the computer. What do you want to do? Debit. What'd you get? Computer. Well, computer. It's computer itself. So computer, right? Equipment for computers. Office equipment, computers, something like that. So I think I debit equipment, or you can debit computers too. Some companies use that account. What do we give them? Cash. Right, guys? What else? Promise to pay them, note payable. Starts getting easy, doesn't it? Okay. That's what it was. All right, now it gets harder. What entries do we have related to that? 1 month later. We need to depreciate it for 1 month? You bet. And then what else do we need to do? Record the... Yeah. But what about the debt? Interest expense, and that'll give us interest. We're not paying it, so it'll be what? Interest payable. Got it. So we're gonna have two entries. One is gonna be debit depreciation expense. And just like you said, we're gonna credit accumulated depreciation. Excellent. So I want to calculate that. And then also, I want to debit interest expense. Absolutely. And credit interest payable because I'm not paying it yet. So I need to calculate both of those amounts, right? And record both of those entries. There's two of them in this case, so this made it hard. Okay, how much depreciation are you going to have? What'd the asset cost? 12. So I got 12,000. Is there a salvage value on this one? No, so it's 0. But I always look for it, right? Residual value or salvage value is 0. Okay? So the depreciable value, the amount I'm going to depreciate is 12,000. And then what? We need the number of years, right? But this is going to be 1 month. What's the life of this thing? 3 years. It's going to be straight line. How many months in 3 years? 36. How about just dividing 36 months in there and finding out what 1 month's depreciation is? That'll do it, won't it? How much is that? $333. Is that right? 333.33. Okay, that's it. Debit depreciation expense, $333.33. Credit accumulated depreciation, $333.33. You could do it, couldn't you? What's the interest going to be? How much did they borrow? $9,000, right? What's the interest rate? 15%. So 15% is for a what? Full year, right? And we only need 1 month. So you could take 1/12 of 15%, right? Times 9,000, or you could take 9,000 times 15% times 1/12, because it's 1 month. Make sense? What's 15% of 9,000 anyway? 900 plus 450, 1,350, is that right? 1,350 for a year. Divide that by 12. That's it. How much interest is that? That's it. Could you do this, you guys? Isn't it funny how it seems harder if the math doesn't work out perfect? Doesn't make it harder, really, to calculate. Okay? So then what happens? We purchased and paid for supplies for $4,000. These supplies were placed in the storeroom. This was the only supplies purchased this month. At the beginning of the month, there were 1,000 of supplies in the storeroom. So let's figure out where we're at. Where are we now, and where do we want to get to? Supplies, inventory. What did we say we started with? 1,000. What did they buy? 4,000, right? So they would have debited supplies, right? Okay. So, oh, I need that entry first, don't I? Purchased and paid for supplies, what would it be? Debit what? What did I get? Supplies inventory debited. That's that 4,000 coming in. And I paid for it, so what would I credit? Cash. What if it said I bought them on account? What would you credit? Accounts payable, right? Could be either way. Okay, good. And then, so how much does that give me as supplies on hand anyway? Looks like 5,000. You start with 1,000 and buy 4,000. Thanks for coming. See you later. That gave you 5,000, right? How much are left at the end for this entry? 500. So how much are gone, you guys? 3,500. So where'd they go? You used them. It's supplies expense, isn't it? Supplies that are gone, where'd they go? I used them. So now I have supplies expense debit. How much? 3,500. And credit what? Supplies inventory. We could do this, couldn't we? 4,500. 5,000, 4,500. That's what you said, and I wrote it down. I apologize. You should have said, Keith, come on. 1 plus 4 is 5. Just trying not to be rude. Yeah, you can't do that with me. I'm dangerous. Okay, so 5,000 less 4,500 is 500. It's 4,500. Okay, I started with 1,000, right? I bought 4,000. That gave me 5,000. And at the end, there's only 500 left. How many are gone? 4,500. Did that work?
Oh, I'm sorry, I didn't see I.
4,500 are gone. And if I had better math skills, I would have worked out. Yeah. And you could hear too. Okay. Yell at me next time. Okay. All right, you got it? Okay. Record payment on the computer debt. So what's that? This is the 9,000. That date that it was supposed to be due is May 31st, 2012 up here, you guys. I now know that because that's when I paid it off. Okay, so let's assume we pay the whole thing. This one gets tough. Let's say we pay this whole thing. We bought it April 1st, right? And we're going to pay it off May 31st, plus interest, aren't we? How much interest have we accrued? This goes back to that idea of did we accrue any interest? How much interest have we accrued? This is an accrual of interest, right? It's an accrual of expense right there. Accrued that expense. That interest payable's on my books, isn't it? So what's my entry going to be? First, what am I paying off? The note, right? So what are you going to do? Debit notes payable? How much are you going to debit notes payable for? How much did you borrow? 9,000. So how much are you going to pay off to pay it all off? 9,000. What are you going to pay it with? Cash. So we need to find out how much cash we're going to give them. Does that help? How much cash are you going to give them? It's $9,000 note payable times what? 15% interest, just like we did up here. 9,000 times 15% interest, but it's not 1 month. What is it? From April 1st to May 31st. The month of April plus the month of May. 2 months. So I think what you're going to do is you're going to take 9,000 times 15% times 2 months over 12. What do you bet? How much is that? It's double the 112.50 we got for 1 month, isn't it? We got 112.50 for 1 month. What do you think it is for 2 months? 225? Is that right? Everybody with me? So I'm going to pay him the 9,000 for the principal plus 225 of interest. Sound good? 9,225. Everybody good? Now let's finish this entry. What did I already do? Oh, by the way, what's the difference between the 9,000 and the 9,225? It is what? Interest. What do you bet? I debit interest. But I already accrued some interest, didn't I? Remember? We made this entry up here to accrue interest, $112.50. So are you going to pay off that interest payable? You bet. So the $112.50 of interest payable goes away, but that's not enough. That was the first month's interest. That was April's. What about May's interest? What'll it be called? Interest what? Expense. And how much is interest for that month? It's $112.50. Both months are $112.50. And is my journal entry balance? Yes. And that one's tough. But you see what's happening? I'm paying off this payable here, right? And then I'm recording the interest for the current month. And I'm paying 2 months interest and the principal goes away. It's understanding the business transaction and then recording it. It's tough. It's getting more complex. Okay? But we can do anything if we can figure out what happened. Okay? That's where we're going to get to. Keep counting on. I can't believe this problem I wrote. These poor students, like you guys. The monster in them. By the way, with a problem like this, it's real long, it's the whole page. What happened at the beginning? They're pretty simple. And then, you know, there's a source or transaction entry, and then there's an adjustment. What if you can't do the adjustment? Do the source entry. And then you come to the next one, there's another source entry. Do it. And if you can't get the adjustment, okay, you can go back to work on them, or maybe you don't get those, right? But do what you can do, don't panic, and just keep going. On one like this, I wouldn't do that. I wouldn't do that J here until I was done with everything else in the quiz or on the test. Would you? Whoa, that's a monster, right? That's why I put it towards the end too. Okay. Provided consulting services to client for $10,000 receiving cash. This is unbelievable. All of a sudden, after a real hard one, what's this one like? What did I get from them? Cash, how much? $7,000. How much did they promise to pay me later? The other three, I earned 10, didn't I? What's the 3? Accounts receivable. What's the 10? Consulting revenue. Oh my gosh. How'd that get that easy, huh? Now that's what's easy, doesn't it? You get a lot of points for these, you guys. Received payment. What did they pay me? Obviously only for the 3, right? Because they already gave me the 7. So what would I do? Debit cash, 3,000. And credit, accounts receivable, 3,000. I know you can do these 2 entries. And I'm going to give you just as many points per entry for that as I am for these up here, okay? For line item. So just do them, okay? Signed a contract to provide advertising services next year. What do you think that one should be? I gave them nothing and they gave me nothing. What do you want to do, you guys? No entry. Give you credit for that too. Okay? That was a good one. There, I thought that. Nothing's easy, is it? It's never easy. There's some more of those increase, decrease things. Here's just what kind of an account it is. That's an easy one. And then prepare a balance sheet, I guess. By the way, this quiz was an hour and 15 minutes in the summer. Yeah, hour and 15 minutes in the summer. I think it was quite that long. This test, hour and 15 minutes, it won't be quite that long. For 15 minutes. To chop off the question. Short minutes. You guys had enough? For now. For now. Take a break, get something to eat, and then get back to work. Right? Study, 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 study.
Oh, also, the picture of just posted from the tree.
Thanks for taking off.